Good morning, folks, and welcome to another episode of where we teach you how to go ahead and work the stock market in a variety of ways. Today's topic is going to be how to identify and trade double bottoms and tops with Bob Iaccino. Bob, how's it going?
Good, man. Good to see you.
It's always a pleasure. You and I have been doing these webinars for about a year, but for the folks at home that might be watching you for the first time, give us a quick little background on your trading journey, because I know you were with the suits in terms of like the hedge funds.
Yeah, I started out on the trading floor in 1993. So that would be what, 33 years at this point, somewhere around there that I've been doing this. It's the trading floor. I started from the bottom, just like most people do on the trading floor. And then from there, I went to a couple of different brokerage places, became chief market strategist at both Nico Securities, then Smith Barney, then became a risk manager at a prop fund, ran my own fund there. It was a commodity pool. And then from there went into the hedge fund of fund worlds, where I was on the investment committee in charge of emerging managers, and traded prop my entire way along this sort of journey. Traded for myself, traded some friends and family money, did a lot of that in the CPO. And in the context of that, started doing financial television. So I did CNBC, Fox Business, CNN, Yahoo Finance, still do some of those today. And then started launching my own stuff after I spent about 3 years at a boutique oil company doing hedging and running their in-house stock portfolio. It was an in-house stock options portfolio. Yeah. So that was sort of that's the abbreviated version. There's a lot I left out.
So you know a thing or two about a thing or two. But however, before we go ahead and dive into those things, we do want to go ahead and put up this disclaimer so that we can come back and do more of these educational webinars. Again, these are, just information and insights that Bob has used in his trading strategy. Him and I have been talking about this for a year. So I definitely kind of understand a little bit of the process, but I'm going to learn through a lot of these things with you guys and gals as well. If you have any questions, please type them in the chat. As we go through this, we will go ahead and try to get the questions in. We're here for half an hour. Then we have other educators for the next 2.5 hours as well at a different link. But Bob, we're talking about how to identify and trade double bottoms and tops as well. So I'm going to share your screen here in a moment, but the main thing I want to ask you is how can individuals, or how do you rather, go ahead and find your patterns in itself? Are you going through a manual scan? What's your process?
Well, I have a couple of automated scans that I created over the years, and they have a bunch of unique characteristics to both of those scans. Essentially, when people tell me what is my stock universe, I tell them it's about 7,800 stocks, because both of these scans are automated. I never look at stocks with under 1 million shares a day. They're just too unreliable in terms of the gaps that would appear in those. I run these two models, and then from those models, I'll get a list of stocks. It'll generally be between 40 and 70 stocks, depending on how active the market has been. If the market's in a bear market, I generally don't get as many. If it's in a bull market, I get a larger swath. And then I go through every one of those looking for patterns that we have used over the years. I do this weekly, these scans. I don't do them daily. From these scans, I develop a watch list, and then those are the ones that I look at daily. So I usually do that on Saturday morning, sometimes Sunday afternoon, depending on what my weekend looks like. And then that's what I look at for the rest of the week. And within those scans, I'll find multiple different signals. We look at 3 or 4 different reliable patterns that we go to see if we want to do a trade in that particular stock. Double bottoms is one of those.
Awesome. Well, I was looking at a couple of different stocks that I wanted to talk about, but I know that you have one that you wanted to refer to as well. So let's do this. Let's put up. I'm going to put your charts up here, and let's go ahead and kind of put up anything that you want to show us in terms of a pattern you're seeing. And folks, what you're going to learn here today is kind of how to identify it, what to look for, and any aspects to the entry, stop loss, profit targets, adjustments. Bob, go ahead.
All right, so I really wish I would have pushed it to where I pushed it while you were talking. But basically what we had a couple of weeks ago was a very clear double bottom pattern in Amazon. Okay, we took this trade. We sent it out in our newsletter, so our newsletter subscribers got this trade as well. So what you're seeing here is 2 bottoms after a down move. Okay, the number one qualifier for double bottoms or double tops is that they're reversal patterns. So they have to be after a move that they can be reversing. So in the case of a double bottom, it's a reversal from a down trade. In the case of a double top, it's a reversal from an up trade. So you have to have this move. So for example, if you looked at an area like, I don't know, let's look at the same chart here. These two bottoms here, that is not a technical double bottom. That is just two bottoms. Okay, that's all it is. In order for this area here to be a double bottom, there would have to be a move that's being reversed. So price action would have had to start somewhere up here, come down to make this first bottom, rally up, come down to make this second bottom, and then you would have a double bottom. Actually, you can see evidenced by the move, which was very weak to the upside, that there was no follow through once we broke out of what we call the double bottom peak, which is right here. The criterion for a double bottom is it resembles a W when it's finished. Okay, you get the down move, the peak, and the up move. And then if it actually trades and continue on, it resembles the letter W. The second thing I look for is the distance between these two lows. Okay, not the width, but the up and down distance. Okay, so what do I mean by that? The right-hand low in the case of a double bottom has to be within 25 basis points on a retracement basis of the left-hand low, plus and minus. So what do I do to look at that? Well, I grab a retracement tool here and I measure from here, which is the left-hand low, to what we would call the peak. Now, if I stretch this out, you can see that in here, I've got these presets at 75% and 125. You can see that this low falls between, and I'll put some horizontal lines there and then get rid of the measurement tool. If I put a horizontal line here at the 75, which is right about there, let me get rid of these red lines for a minute. And then I'll put the other one here at the 125% extension. Now, again, we're using this move from the low to the peak to measure that. Now I get rid of this. Oh, I didn't click it on there right. That's close enough. Now I get rid of this retracement tool and I know that in between these two green lines, this low has to fall in between those two green lines. If it falls short of it or falls below it, does that mean that the move is not going to be reversed? No, it doesn't mean that. It just means that it falls into the category of a lower probability double bottom, right? The reason we have these identifiers is to find high probability double bottoms and double bottoms that we can very easily measure targets and stops for. So that's what we look for in this particular pattern. This particular pattern qualifies as that.
Okay. And then how do we, we talked about qualifying as a double bottom. How do we go ahead and identify when to enter, where to have your stop loss, where to have your profit targets, if there are multiple profit targets that you prefer to use as well? Yeah. But let's look at the same example here.
So let's go ahead and remember that this one fell within the category it needed to fall into to qualify as high probability. So I can delete these. The proper entry for these is a close above the peak, okay, which would fall right in there. And generally, you saw the colors that were on here before because, again, we actually took this trade. I'm going to try and stay consistent. For me, it's blue. What's that?
Can you move your charts a little to, like, I think there you go. Yeah, I think I was going to say part of it. There you go.
Yeah, I'm trying to leave it there because it's obviously there's a spoiler here, right? It's when you saw it before, you saw that basically it ended up being a profitable trade for us. But what I usually mark that with is a dashed blue line. Now, what you want is a close above this particular high. Okay, this high comes in at 220.47. Now, obviously, this did not allow you to pre-predict a close above the high, and this is a weekly chart, meaning it has to happen on the weekly close, which is Friday. So the way that I affect a trade like this is I go ahead and I enter on a stop. And if the trade then closes below here on Friday, I exit it and I take the small loss. Now, you want to know what the targets want to look like. That's the proper entry, is a close above this point.
Right.
Okay. It is a real bad habit to get into to front run these, by the way.
Amen to that.
This particular move is happening. And the reason is they don't always close above. Oftentimes they test it and they continue on a down move, in which case it is a double bottom that never confirmed, right? It is a formed double bottom the second that it trades above this peak. We call that a confirmed double bottom, but not a triggered double bottom.
Yeah.
And it can still trade above here, collapse on news, and then go on down toward whatever, 168, the 200-day moving average, doesn't really matter. But the way that I personally enter these is I'll put a stop. Again, this high level here was 220.47. I'll put a buy stop at 220.48, and then I'll watch it, right? Now, the next question is, where are the targets and where are the stops, right? I use the exact same tool, and instead of measuring from here to here, okay, I do the opposite. I measure from the high to the low, all right? And within that measurement gives us everything we need. I'm going to go ahead and stretch this out again. The stop level, the technical stop level, is a close below this 0.375 level. So let me go ahead and put a red dashed line there where this is going to be approximate. I'm going to change the color so we can see it. That's going to be my stop, and that's going to be a close below that level. A lot of people then say to me, well, what if all of a sudden it just, wow, this really moved when I colored it. And what if all of a sudden it just completely collapses and I don't want to wait for the close? Remember, this is a weekly chart. So you're talking about a weekly close. We also have what we call a trade below level, and that's this 0.25 level right here, okay? And I usually make that on my chart so I can identify it. I make it a solid red line. Those are my two stops. A close below the 0.375 retracement, or a stop or a trade below the 0.25% retracement. Now, for those of you that don't have these 12.5 point spreads, you can use the closest Fibonacci's for that. So for example, the 375, you can use the 32.8. The extension of the 75, you can use the 78.6. The 125, you can use the 126.2. Forgive me if I'm off by a couple decimal points. I haven't used Fibonacci's in a long time.
So your stop loss is not below the bottom, I guess.
Nope. It's not below the bottom. Based on our research, when you get through this 0.25% retracement, it's got about an 87% chance that it's going to break the bottom. And that's good enough for me. It also allows me to get in a little bit above the high and get my reward to risk to be close to 1-to-1, which is generally my minimum threshold for these kind of trades.
Yeah.
Right. It allows me to do that. And because we did the research on this, we don't have to worry about this low, because we know that if it gets below this 0.25, it's got a very high probability of breaking that low anyway.
Yeah.
Because what that means to a lot of traders that look at these doubles is that it's failed. The double's not going to play out. So they tend to exit. I would be one of the people exiting that. Yeah. So based on this, let's say I get a chart, my stop in above here works out, and I don't get a close above this level. I'll have this stop in place the whole time. So that's going to be my risk from there to there initially. And then in absolute terms, it's going to be my risk as well. So then the second thing I look for on here is three targets. Now you have to measure the targets and see where the targets come in. This is the move that's being reversed, right? So in order to mark your targets, this 200% extension, which you can get on Fibonacci's as well, has to be within the move that's being retraced. If it's not, that 200 is not a valid target. So let's imagine that when I measured this, the targets were all the way up here. Let me just tighten this up, okay? Let's say that this is where the peak was. Now the target exceeds the move that's being reversed. So this is no longer a target for me. The 175 or the 200 are no longer targets for me. I can't take this trade because the measured move is not correct on that one, and it becomes lower probability. In this particular example, the 175 and the 200 extension of this move are my targets, and they both fall within the move that's being reversed. Okay. The other part is this 150 extension right here. When we hit this 150 extension, and again, I'm going to use my typical thing. I use greens for my targets. When we hit this 150, I can now start moving my stop up. I can use a trailing stop. Why? Because the probability once we get above this 250 is in the high 70% range that we're going to hit the 175. It's usually a piece of news that turns are dramatically lower. It's not within the fundamentals of the stock, right? So once we hit this 150, I go target 1, 2, and 3. Target 1, I tighten my stop. Target 2, I take a portion of the trade off. Target 3, I take the rest of the trade off. And here you can see that that is exactly what happened with this Amazon trade that we put into our newsletter.
Do you prefer to trade weekly double bottoms or daily double bottoms? Because the theory is a longer out term, it is better.
I prefer everything weekly over daily. I prefer daily over 4 hour. I prefer 4 hour over 60 minute.
Yeah.
The more information you have, which is what happens in it, a weekly bar has more price action in it than a daily bar does, right?
Yeah.
The more information you have, the more reliable the pattern is. But I will take daily double bottoms and I will take 4 hour double bottoms.
Yeah.
They're just minute percentages less likely to hit their targets than weeklies are.
Now, there's another criteria, at least that I know you have, because you and I talked about double bottoms this past weekend. You asked me a question of, does it at least have 1 million in daily volume? Why is that important? And are there other little knickknacks like that that you like to have met?
This is just a personal thing. If it has less than 1 million, it's prone to more gaps. And if it's prone to more gaps, I'm less likely to get in at my desired target to own the stock. And I'm less likely to be stopped out with minimal slippage. So that's really just a liquidity thing. I don't take any trades in stocks. Actually, that's not entirely true. I do take trades with stocks under 1 million shares traded per day, but I categorize them as high risk stocks. So I'll have a much lower risk tolerance on that. Not a different stop, lower position size. That's the way that I always manage that.
I've got a stock for you to look at that I believe has a double bottom. I'm going to go ahead and share mine here for a second. Put this, there we go. Okay. For me, it's Best Buy. And again, I use like a different, the trading view. Here's what I do. Trading view has like your double bottom, little identifier or whatever. So this is how I kind of do it. But I want you to let me know, you're the expert here, on if you believe this is a good enough double bottom for one to get into. And again, folks, we are not telling you what to get into and what not to get into. We're dissecting different kinds of double bottoms and what's a healthy one and what is not. So educational purposes only. But what do you think about this Best Buy double bottom that I found yesterday? And you can pull up this.
It's not a double bottom I would take. And the reason is the move that is being reversed is not the one traced by the TradingView tool. It's the more, no, that's not it. It's the more recent high. Okay, so it's going to be difficult for me to tell you, but it happened in the beginning of March. That's the move that's being reversed. Keep going to the right. That's not it. Keep going to the right, the other right.
Oh, sorry.
Keep not that high, but the one to the right of that. That's where the move that's being reversed is starting. Why am I saying that? Because you have a massive rotation to the left of that right? You have a lower low.
Yeah.
Okay. That lower low is part of the extended down move. So, but there's a correction within it, and it's the correction within it that's being reversed.
Yeah.
And that's not a long enough down move that's being reversed to make the targets viable.
Yeah.
What I'm basically saying is that high that I pointed to, that's really on the second B right now, right there, that's going to provide massive resistance to the upside. And we want a smooth move that's being reversed.
Yeah. This did look a little, it wasn't as clean as some of the other ones that we've kind of talked about. Another one that I have here is CRL, which
that's
again,
a good one.
This one you did like.
Yes.
Now see, this is a cleaner downtrend.
Much cleaner down move.
Than the other
which
one.
Which ups the probabilities. On the way back up, after you get the trigger, it absolutely does not have anything in the way, really. The thing that would be the most in the way is that late December low. But even that is not going to be strong enough in the face of the move. More recent price action has more power than older price action. Okay. Yeah. That smooth move down, that's an area that the market wants to retrace. It's like a magnet. So while there may be a pause in that late December low, it's not likely a strong enough resistance area to stop a double bottom from completing its targets. Now you have Fibonacci tools there, right? We can use the example of Fibonacci's. If you retrace the high, which is the peak of the double, the peak of the double.
Right here.
No, so the double it's a W, right? The middle point is the peak down to the left-hand low.
Right there.
Okay. Your targets are listed in there. Now, this is a natural, unadjusted set of Fibonacci's. TradingView allows you to adjust the Fibonacci's, but if you don't want to do that, if you want to operate with Fibonacci's, you can go ahead and click on the 200 extension. There's going to be somewhere around there is a 200 extension, right? And you're going to see that it's just over that. Actually, let me put it on my own. You don't change your chart. I'm going to put it on my own to follow along. It's CRL, right?
Yours too, if you want. Yeah, CRL on the daily, if you want.
All right, I can just show mine. That's fine. I can just show mine. So CRL on the daily, that is very clean. So let's go ahead and go through some of the measurements that I talked about. First, let's measure the distance between the two highs. And we do that by going bottom to top. Okay, so from the bottom here to the top. And you can see that this low, just tell me if it's clear, Z.
Yep,
this low is within the 75 and the 125. Okay. Now with Fibonacci's, you can use the 78.6, and I think the 120 is like a 121 something. You can use that, right? It'll shift it a little tighter, but it's okay. It's just going to keep you out of trades rather than make you take trades that are bad, right?
Yeah.
It's such a slight, minute difference that it's going to go ahead and work. Okay, so here's the right-hand low fits. Now we get rid of this and we retrace the opposite way from high to low. And you can see that the 200 retracement right there, which is the price is 218.97, falls within the move that's being retraced. Okay, it falls right within it. So this is your final target. The 175 is your first target, and then the 150 is where you adjust the stop. Now, this is the, you know what, I'm on the weekly, but that's okay, it works. Let me go to the daily and do the one you were pointing to on the daily. It's this one here, right?
Yep.
So let's do that same, this is the same one on the weekly, by the way, there's just fewer bars in it. So the 200 fits, the 175 fits, and the 150 fits. The other thing that's beautiful here is the entry is above the 200-day moving average, which is the red line.
Yeah.
Here's where multiple time frame analysis comes in. You've got your 150 here, which is 200.81. That's where you move your stop up. You tighten your stop up to reduce risk. Your 175 is target one. You take off whatever portion you want to take off. Okay, mine may be different than yours. And then the 200 is where you take off the rest of the trade. I never advise people how much to take off unless I have more of a relationship with them in order to be able to talk about, you know, how they are as traders, right? And we can even remeasure this on the daily to show that they fit. You can see that the low breached the 75 and did not breach the 125. So it fits. And then our stops are in very clean areas. And we can watch this going forward because in theory, you would have gotten long here.
Yeah.
On April 17th, Friday, which is where you got the close above this point, right? A couple people may have said, well, I'm going to use a stop in. So there's a stop in, didn't go your way, didn't go your way, didn't go your way, but then closed above here. You are able to stay in it at that point as an actual triggered double bottom that has a high probability of going to targets. And you can see that all the moving averages I use are going in the direction of the double bottom. They're moving in that direction. So it's a beautiful thing. Does it mean that, you know, that increases the probabilities it's going to work? No, it doesn't. It doesn't mean that. The only negative on this one, and I wouldn't call it a negative, is that if you look at the weekly, the 200 week is in the way of your first target. But that's not that big a deal. If you don't like the trade at that point, you're likely getting out at a profit. But I believe that when the daily is driving like that, that it's probably going to break through this and at least hit that 150 or you can tighten your stop.
Ben had a question, and I apologize. I am bringing this up a few minutes late, so it may not make sense at the moment. He asked, are you basing that thesis on the gap up, Bob? If you know what he's talking about, great. If not, Bob, if you can let us know what thesis you're referring to, I can ask the question again. It was about BBY. We were talking about something.
A gap up. Well, no, I'm not. No. So let me put BBY on my charts. And that was a daily, right? See?
That was a daily, yeah.
Okay. If you're saying, am I basing my thesis on the gap up? I'm assuming you're saying, am I basing my rejection of this double on the gap up? Okay. And I assume he means this gap up because I don't see any other gap up except maybe here. What I'm basing my thesis on is that this is the move that's being reversed. Mm-hmm. Not this, not this, and not this. Why? Because there was a big giant rotation here. It was almost a lower low.
Yeah.
So this is the up move, and this is the down move. Okay. When you have moves like this, you have strong resistance levels here, here, here. You have a lot of choppiness in there. Even though it's a down move, you have choppiness that is going to cause resistance to the pattern. So when I measure the targets out on Best Buy here, I would measure from here to here. Okay. The 150 specifically has to go through this resistance level first to get there. And you can see the market struggling against that level. It's happening right now as we speak. So it has nothing to do with the gap. It just has to do with this rotation here. This is now the move that's being reversed, not this one, right? This is almost a triple bottom, more so than a double. There's a bottom there, a bottom there, and a bottom there. And if you look over time, if you study triple bottoms, they tend to be continuation patterns, which would mean the more likely long-term move is down, not up.
Got it. Let's go rapid fire because I've only got about a minute or two before we have to move on to the next webinar. But do you ever re-enter a double bottom after getting stopped out on the first one?
No.
Okay. Is that just because the probability is just like it's broken?
Well, there's two scenarios there, right? I stopped in and then got stopped out. When you trade below the 0.375 initial stop level, if you close below there, the probabilities of that double resuming and working fall below 50% based on our studies. Yeah. So no, there's no reason to get back in there. Now there may be another long signal. Right. There may be one of my other strategies that gets me back in there, but not on a double bottom. No.
Okay. Do you ever so on the Amazon weekly, right? It just kind of shot up. Now, obviously on the daily, you may have had a bit of a re-entry possibility there, but what are you doing in that case? I know you mentioned a buy stop. Are you waiting for like a daily close possibly? Or are you saying, hey, I'm going to get in as a stock is moving through my entry price. And if it's below a certain price by the end of the day, aka it doesn't close above, I'm getting out.
It's very easy to explain from this. My partner doesn't do what I do, okay? He waits for the close, and then he looks for a pullback to the level to get in. He didn't get it here, okay? I bought on a stop in here, and I used my normal stop. And I'm willing to lose on more trades than he is, right? He's more strict about it. I bought on a stop in buy, and my stop was at 220.48. And then I just kind of kept my fingers crossed and my stop, I used this as my stop. Yeah. So the risk on a percentage basis was from basically here to here, which would have been a drop of about 6% on the 5.5% on the stock, a little less, a little more than that. There was also another one, if I could take 2 seconds.
Literally.
General Mills had a possible double bottom here. Okay. This is why we don't front run these. Okay. So this was, that's a week I want to put on a daily. Right here, this was Friday. So here's bottom and bottom. This was Friday the 10th. Yeah. That's okay. Okay, cool. If we get a rally up, we'll get in. Some people I'm sure said, oh, we got a double bottom. I'll go ahead and front run it and get in early. Yeah. This is why you don't get in early. Yeah. Because without the trigger, it can continue lower. Yeah. But this was the Friday one. And then we dropped down to here. We broke through that 125. It's no longer a double bottom.
Sweet. All right, Bob, appreciate you, folks. We will be back next week with more trading strategies. This is exactly the type of content you can expect. If you guys have any questions, obviously, we always welcome them. Any topics that you want to discuss, let us know as well. And we'd love to go ahead and kind of put on different type of education stuff for you. But Bob, always a pleasure, my man. Thank you so much.
Good to see you, man.
Take care, folks. Bye-bye.